Good morning, everybody. Can you all hear me at the back? Yes? Great. We are the Global Sustainable Investment Alliance. We'll explain shortly who we are and what we do, but first of all, I want to understand who's in the audience. So, get ready to put your hands up. Please put your hand up if you are from the Americas, north or south. That's a lot. What do you reckon? 15%, 15, 20? Please put your hand up if you are from Asia. About 5%. Please put your hand up if you're from Australasia. Simon O'Connor promised me 100 Australians. He's about 96 short. Never mind. Please put your hand up if you are from Europe, the UK, or the Middle East. Okay, so that's the majority. Africa, if you're from Africa, please indicate. No one from Africa, so that's our joint mission for the next few years, isn't it? Anyway, thank you for coming. We are, as I say, the Global Sustainable Investment Alliance. We are a grouping of local market bodies, and what differentiates us is our deep, active knowledge of our local markets and our involvement in the policy and financial service provision in those markets. The purpose of the Global Sustainable Investment Alliance is to deepen the impact and visibility of sustainable finance on the global stage. There are 5 members, you see them listed there: EuroSIF, which is Europe; RIAA, which is Australasia; UCSIF, UK, that's my organisation; USSIF, Lisa Woll on the end; and the VBDO, which is the Dutch SIF. SIF is a kind of shorthand we use. Used to mean Sustainable Investment Forum, but it now means one of these nationally focused membership bodies. And there are SIFs in many countries: Canada, France, Germany, lots of countries. We are probably best known for the biannual report we do on the state of responsible investment globally, and I'd like to thank Bloomberg, our sponsors of that report. The highlights of the report there, it's all on the web. The key things: $23 trillion managed by our members in sustainable finance, and a growth rate over the 2-year period we reported on of 25%. In addition to the SIFs represented on this panel today, the report includes comments on Canada, Asia, and there are sidebars on Africa and Latin America. My 3 colleagues are each going to speak very briefly on things they're seeing in their region. It will be brief. We'll then do some moderated questions. But the key part of this session is that you are going to ask the questions, okay? So I need you now to think of questions sparked by what my colleagues say, and then we'll be coming to you. First person to speak, Flavia Micilotta, the Executive Director of EuroSIF, the European SIF. Over to you, Flavia.
Thank you very much, Simon. Very happy to be here with you all. For those of you who do not know EuroSIF, I'd just like to spend a few words. We are, of course, the European leading organization for the promotion of sustainable and responsible investment in Europe. We have members across different member states, of course, in the UK, in France, in Germany, Austria, Switzerland, Spain, and the Netherlands. Of course, what we'll discuss today really has to do with the trends that we track as part of the Global Sustainable Investment Alliance every 2 years. And indeed, the findings in the study really reflect, to a certain extent, also the finding that we analyze in our own markets, so to speak. So I'll show you what the main highlights from the European regions look like. For those of you who are mostly familiar with the EuroSIF study, which we also publish every 2 years, this will not come as a surprise. Of course, we see that the total assets committed to SRI grew by 12% over a period of the last 2 years, from 2014, with a total of $12 trillion, making over for 52% increase of global total assets under management in SRI. This year, we see again an increase in exclusionary screens. This really mimics a spree of divestments that we have seen from many countries, not only Europe, but on a global level, I would say. and indeed remains as a top strategy, as I said, with over $11 trillion, rising up to 48% since 2014. This strategy is stronger in countries such as Switzerland, where it's already at 2.5 trillion, and the UK, where it registered last year a compound annual growth rate by 99%. Of course, you're very familiar, I suppose, with the main themes that are part of the strategy in terms of what are the categories that are typically on the exclusion lists for investors. But we have seen typically a rise in the last 2 years, mostly of carbon issues being on the topic. And indeed, issues such as COP21 has made it so different players such as pension funds, but also municipalities and other players to really get involved in divestment strategies. The second one is norm-based screening, which is the second biggest strategy with $5.55 trillion, rising to 40% since the last 2 years. And indeed, these strategies shows the main increase in France, where it's in pole position at 2.5 trillion, and it's followed by the Netherlands. Engagement in voting is the third most important strategy, and indeed, it is most important in the UK, where it takes the lead. This signals a very important point that we'll discuss more in depth in the course of this debate, I hope, and it has to do with the important correlation between policy and the developments of the different pushes and pulls that we see in the SRI industry. So in the UK, this strategy leads at 2.5 trillion, and the Netherlands follows with 726 billion. On the rise, we also see impact investing, which remains small at $107 billion. But indeed, it is the fastest growing strategy that we've already started tracking in our own study for the past 2 years. And it signaled an increase by over 400% over the past 2 years. So you can, of course, appreciate the importance that this is taking. Best in class continues to grow and remains at 40%, with assets under management overall in Europe at 493 billion. And France continues to lead in this strategy as well. Sustainability-themed investment is another strategy which has continued to grow quite substantially and which has been linked mostly to the debate around climate issues. So I think these were the main highlights from the region.
Thank you for that, Flavia. And the thing we'll pick up with you is policy. Okay, thanks very much. I'd like now to hand over to Simon O'Connor from Australasia. Simon, over to you.
Great, thank you. So I've come quite a long way to be here today, so I thought I'd bring a bit of a story to start this conversation off with. Something that I think is really relevant development in one of the markets that I represent that occurred about a year ago that I think is relevant for all of us here at this conference, and that's New Zealand. And if you go back about 12 months, the leading national newspaper came out with an article on their front page highlighting that the pension plans for all New Zealanders all had exposure to cluster munitions, nuclear weapons, landmines and tobaccos, and quantified that on a dollar basis for every default pension plan in New Zealand. This resulted in effectively about a month of media uproar, parliamentary questions, investigations by the federal police, recommendations from the Prime Minister, and effectively within about 4 months we saw the vast majority of the New Zealand finance industry put in place responsible investment strategies, including exclusions across approximately 60% of the industry. So I think what I've taken from that is something we haven't heard a lot of at this conference that I think is really critical, and it's remembering the people whose money we all manage and who we all represent, those underlying beneficiaries, our clients, the citizens of our countries. And I think we've, as an industry, have misconstrued some pretty important signals over recent years, and that is that when we see a fairly low uptake of those ethical and SRI and sustainability-themed products proportionally to the market, we still see pretty low retail demand for those relative to the market. I think we've all interpreted that as our beneficiaries don't really care too much about the way their money is invested, that most of them aren't actually willing to put their money where their mouth is. What I take from the whole, what we call the KiwiSaver example that I just talked about, the New Zealand pension plan, is that in fact, when the average person in the street does find out that they're invested in industries that are creating harm, that are breaching social norms. In fact, there's an uproar, and in fact, they show very clearly that their expectation on all of us in this room is that their pension plans are managed in a way that, as a minimum, does no harm. And I think that's a lesson that was loud and clear through New Zealand, is really one that's relevant for the whole world. And so as a result here, it's not often we get to go out with a media release saying you've seen 2,500% growth in 12 months, but that's what we went out with about a month ago, where 60% of New Zealand had put in place responsible investment policies, exclusions, and we're seeing similar but not quite as dramatic trends across Australia, where today we've seen about a quadrupling of funds under responsible investment strategies in the last 3 years. We've seen approximately 1 in every $2 invested in Australia now is invested under a responsible investment strategy. The biggest portion there, I guess, is largely your ESG integration funds. And importantly, the way we calculate that is we do look at about 100 managers across the region. We rate them on how well they can articulate and demonstrate ESG integration, and we only include those who can really demonstrate clearly a leading approach. So those that score over 80% on our ESG integration framework are included there. So effectively, that's about 16 of 100 managers, and it's a framework I'd encourage you to have a look at. But we've seen a really strong push, and I think what's really important there is if you look at some of the drivers here, we've just seen a massive switch on the demand side. And it's really, we see both at a retail level and an institutional level, and really that middle market of family offices, foundations, charities, are really awakening to the opportunities right now to be aligning investments with values and with mission. Pleasingly also in Australia, I think the case has been made really strongly that ESG matters, it's financially material. It's not what we spend a lot of time now talking about or having to prosecute the case for within the investment industry. So I think we're sort of winning over that argument in a lot of ways. And as you can see, this is really effectively what's happened in the last 3 years in Australia from the demand side, and that's our proxy really for retail demand, where it's really taken off with a growing awareness. And with that, we've really sort of started to break some of the greatest bottlenecks, I think, in the market, which is lack of critical mass, lack of awareness, and the lack of demand, which now we're getting to a point where that demand is really resulting in a lot of products coming to market across asset classes, across investment styles. So we're now really pushing the supply side is really delivering for that demand, so which we can explore in a little bit more detail. But I'll pass on to Lisa.
Okay, so I'm Lisa Woll, and I'm the CEO of EuroSIF, the Forum for Sustainable and Responsible Investment. And we're the leading organization in the United States advancing sustainable, responsible, and impact investing across all asset classes. The responsible, sustainable, and impact and across all asset classes are important key messages, and we can talk about that a little later. I'm just going to go through some of the key data points from our trends report that we put out last November. In fact, within the same time period that Donald Trump was elected president, which I suspect some of you might ask questions about towards the end of our presentation, but it's they're almost entwined in my mind, because as we did media for trends, there was a lot of questions about the recent election. So SRI assets rose in the United States 33%, from $6.57 trillion in 2014 to $8.72 trillion in 2016. Eliminating double counting for assets involved in both strategies, ESG incorporation of one strategy or another, and shareholder engagement. We saw slightly more than 1 in 5 professionally managed assets in the United States invested using one or more sustainable investment strategies. ESG integration was the most widely used strategy, affecting 5.8 trillion of SRI assets. I think the topic of ESG integration is really an important one and a necessary one to talk about. I hope we'll come back to that later in this session. Some of the key findings in ESG incorporation: climate change was a key factor in ESG incorporation in terms of issues that were addressed. A general ESG criteria, around 7 trillion, was identified for money managers and 1.3 trillion for institutional investors. What does that mean? It meant that the respondents to our survey did not identify any particular ESG criteria that they were utilizing. They just said general. That gets back to the topic of ESG integration. And then community investing, which I understand David Wood talked a little bit about in plenary this morning. This is something that's very important in the U.S. SRI market, investing in underserved and marginalized communities through things like community banks, credit unions, and loan funds. And that went from $64.3 billion to $122 billion. Shareholder resolutions are very key ways to interact with companies that you own, of course. And the two major issues that we found were political spending as a result of the Citizens United decision in the United States Supreme Court, 377 proposals, and proxy access, ability for shareholders to put board candidates on the ballot, 350 proposals filed. I also wanted to add that the assets engaged in the shareholder resolution process increased from 1.7 trillion to 2.6 trillion between 2014 and 2016. I know we'll be talking about policy later, but several big issues exist for us right now. One of them is the Financial Choice Act, which for those of you who were at the plenary late in the day yesterday, you also heard that referred to, so I'm going to be happy to follow up on that here. Okay.
Okay, thanks very much. I'd like to thank my three colleagues for speaking and keeping to time. It's a discipline we pride ourselves on. This is a little bit of a UK boast. This is a statement which EuroSIF and a partner organisation in the UK, we were successful in getting 12 of the UK investment consultant firms to sign up to this. And it means the consultants will take the UK version of fiduciary duty and ESG investment, they will take it actively to their pension fund clients. So we're very pleased to be able to work with such an influential part in the pensions value chain, and we hope to hook up with Will Martindale of PRI to see how this work can be taken more globally. So it's a UK initiative. We focus on the UK. We'll work with partners of all kinds to take it globally. Now we'll do some questions. We've got a few prepared. You won't be at all surprised, and they're going to focus on some of the stuff which was said. Flavia, you mentioned policy. I think what might be interesting to our friends in the audience is if each of us outlines quickly the policy work we do. Is it a priority? Is it a side issue? Where does it fit into your agenda? So Flavia, do you want to kick off first? Policy work for EuroSIF.
Thank you,
and
Simon.
perhaps HILEG.
Yeah, indeed, HILEG, which is an interesting acronym, of course, which I believe that has been going around in the conference in the past, since yesterday. Indeed, policy is very central to what EuroSIF does. It's always been the case. This is how we were built, indeed, because it's embedded in the way we promote sustainability in Europe. And indeed, we understood that the most valuable way of doing that was indeed to work with policymakers and regulators in order to make sure to advise and share with them different actions that are already happening on the private sector, on national level, on the side of different member states. So what we do is we try and have a discussions with policymakers in order to make them understand what are the trends and what are the needs of the investors community, of different stakeholders, bringing forward interesting examples of what's working in countries such as France, for instance, bringing forward all the data with relating to the interesting policies that they have been implemented there. And indeed, in this way, we accomplish our mission, which is, in a way, to promote SRI, at the same time promote the role of our members, not only by helping them in their work at national level, but also by raising the SRI agenda at European level. So, of course, our work has been recognized, and we were very much happy to put a more emphasized focus, I would say, on the role that policy played in terms of streamlining and pushing the demand for SRI forward, and we did that in our study last year. And indeed, all the work that we've done highlighted and pinpointed to a need that European regulators actually were not blind to. They actually saw that there was a momentum going on, different activities being taken from the private sector mostly, but then also, of course, events such as COP21 did a lot in, raising the agenda on climate once again, and other events took place. And indeed, the European Commission was very keen on continue to work on some policy pieces that were already in the making. I'm talking about the pension directive. I'm talking about IRPs, of course. I'm talking about non-financial directives and the relevance that had on disclosure, not only for issuers, but also for investors. And it kept on doing that, and it kept on, the last one was indeed the shareholder rights directive, picking up on best case examples such as, of course, the work of the stewardship code that we saw in the UK. And he decided to set up this high-level group of experts on sustainable finance, which was created, as you've heard yesterday from our chair, Christian Timman, late last year, and which started working in January this year. The aim of this group is indeed to provide and draft a blueprint for sustainable finance. And it calls on this group of 20 experts that we are representing, of course, the investor world, but also academia is there and different side of other stakeholders to actually work together and see what's possible in terms of devising a more sustainable financial system, making sure that the financial flows go in the right direction, helping towards a speedier transition economy, and making sure to rise sustainable and responsible investment.
Okay. So yeah, I think the high-level expert group is one of the key developments underway globally, and I'd urge every member of this audience to keep an eye on it. The EU Commission is saying they will legislate on the recommendations. They will be driven through, and they're probably going to affect every stakeholder who's selling into the European Union area. So key work for EuroSIF. Great. Simon, I sense, on what I know of the Australian market, policy's slightly different down there. I mean, how does it work with you?
I'd say we're a long way from having a high-level expert group on sustainable finance in Australia, and we're probably not likely to get one anytime soon. So I think the policy environment is really lagging and probably a bit slower than the investment community is moving. I mean, there are engagements going on jointly with the PRI, with our regulators around fiduciary duty, and we do expect that to slowly change, but it's taking some time. We have seen some signalling from APRA, from one of our leading regulators around climate risk and the importance of climate risk. So there's some movement there. And then at the edges, there are a few little developments that are helpful, such as a stewardship code for asset managers, which has just come out from a finance sector industry body. Equally, we're seeing some supportive comments around impact investing from the federal government in Australia at the moment, and a few dollars starting to flow to support the development of impact investing. And then more broadly, sort of policy environment that kind of enables or allows responsible investors to consider ESG risks. There's some movement there. We're likely to see a Modern Slavery Act legislated later this year, following the UK model and influenced by the French as well. But we have seen some developments at both the exchange levels on disclosure requirements for listed companies. So the NZX, the New Zealand Exchange, updated its corporate governance code last year, requiring ESG disclosures. The ASX did something similar a couple of years prior. So there's some movement, but it's really not what's leading and pushing the industry.
I think a feature of the national SIFs is we're all very small, resource constrained, so we push where we're going to get most effect. Clearly for Flavia, that's policy. For Simon, I think you've made it clear it's less policy. It's some of your more market-orientated activities. Lisa, you're the one where the policy environment has changed dramatically. How are you playing policy under Mr. Trump?
Right. So I wonder, before I answer that question, for those who are asset managers or asset owners in the room, can you put up your hand if your firm or anyone in your firm is tasked with engaging with regulators or your national legislature? So for whom policy is seen as a strategy of your work? How many of you in the room have that in your firm? Okay, so maybe about 15 or 20. Great. So at EuroSIF, about 8 years ago, we really decided that policy was a key priority strategy for us, and we have really led on that in the sustainable investment marketplace in the United States. Not necessarily because it will immediately push a lever to make sustainable investment a more utilized strategy, but because we believe it is a systemic frame in which our work takes place. And that's both at a level of what are the rules around the financial markets and what are the impacts on the substantive issues that we work on. So climate change, of course, is a great example. So we work on it at two levels. We have a policy committee that works with us at a staff level. At the staff level, we're extremely engaged with the Securities and Exchange Commission. We used to be very engaged with the EPA and the State Department. We are still very engaged in the House of Representatives and the Senate. So we spend a lot of time up on the Hill trying to make policymakers aware of SRI, not even talking about legislation, but saying, do you know anything about this field? Do you know how many firms and institutions in the private sector are engaged? This gets policymakers' attention. So we spend a lot of time trying to build knowledge. Then we spend time on issues that we care about. But then we have our members. And we have over 300 members all around the country. And we try to really utilize their policy muscle. So much so that we're trying to really grow that. And next year, we'll be rolling out a policy leaders program so that right now, we have, sort of the critical mass of people whose firms have decided this is important and historically has been important, and they've worked with us for a better part of the decade on policy. But then there are a lot of other firms where they come up to Hill Day. We do a Hill Day once a year where we take our members up to the Hill to talk to members of Congress, and they will come up to me afterwards and go, my God, that was the best thing I've done in the whole time I've been a member of USIF. And then they don't reach out to a single elected or appointed official until the next time it's the best thing they've ever done with USIF. So what do you do to build that gap? You've got to bridge that gap if we're going to be effective. So we're rolling out a policy leaders program where organizations will have to say, we don't work on this now, but we're going to appoint this person in our organization to spend at least 20% of their time on policy. And in exchange, USIF, you are going to take a year and run them through a training program so that they know what to do. So I'll let you know the next time I talk to you how that goes. We're going to start that at our conference next year, but we think it's absolutely critical. I know you want to go on to the next question. I'm happy later to talk about the Financial Choice Act, climate change, what it's been like to go from a really a position we were able to move some priorities forward under the last administration. We changed ERISA guidance so that we could make clear to corporate pension plans that they could use ESG criteria in their plans, that they could do shareholder engagement. That still stands. But obviously, we've gone into a defense position where what we're doing right now is really trying to defend against rollbacks or diminution of existing law and regulation that both help the field, but also help so much of the world, whether it's through climate or disclosure on conflict minerals or pay disparity, and I'm happy to talk about that more later.
Okay. So we'll do one more question to the guys, then I'm going to come to the floor, so keep thinking of your question. And the area I'd like to explore is the retail and the citizen here. Lisa Woll recently wrote a piece, I'll quote one sentence out of context, Lisa, and then ask you to pick it up. You said retail can be the next big thing if. What follows the if?
Well, I think first, one of the big ifs for our field in general is messaging. So if we can message the retail market in a way that is understandable, I think I don't surprise anybody in the financial services industry to say we use a lot of insider language that is oftentimes incoherent to even an educated person on finance, let alone a retail investor. We need to do better on that. We need to stop talking just to ourselves if we want the retail market to enter this field. So that's the first issue. The second issue is what can you do for products? Right now in the US, for example, we have mutual funds and we have some ETFs. And then we have some loan funds, some fixed income products that are actually available to non-accredited investors or retail investors. But what we don't have are some products that might make them feel that they're being able to do local investing or that they're able to enter the private equity market in some way. Or that they're able to do the kind of broader-based investing than they can currently do in one mutual fund or another. And so what I think has been interesting in the US is that the financial advisor market serving retail clients is doing a lot more training among advisors so that they understand this field, because there's nothing worse than if you're interested as a client in sustainable investing than going to your advisor and saying, I really want to do this, and they say no. And you don't know enough to have that argument or to go find another advisor. So the training's critical in the US, and the products are critical. So robo-advisors have become something of growing interest in the United States. In the last 4 months, at least 3 new SRI-only platforms have begun. And that's in addition to robo-advisors that are creating sustainable investment portions of that. So that means a retail advisor can go in and do investments across a range of stock holdings that are all invested in a sustainable way. That kind of product will really help drive the market. And I think retail advisors knowing more about this, and then just getting more coherent messaging out there about the fact that this is available to the broadest range of investors is incredibly important.
Simon, I think in Australasia you'll pick up on some of those things, particularly the messaging. Give us a couple of minutes on retail in Australia.
I think, as you saw in one of my charts a little bit earlier, that was basically you're reflecting the demand from our best proxy for retail demand over the last decade or so, and you would have seen a chart that flatlined for about 10 years and in the last couple of years has headed upwards. Effectively, we're still sitting at somewhere of around 5% of the market proportionally is our best bet of sort of retail demand choosing responsible or ethical or SRI products. I think we've seen a significant upswing, but when I look at that chart, you know, the conclusion for me was that I think as an industry we've not been very effective at cutting through and telling the story and the great positive stories of a lot of what responsible investing does in terms of directing capital to more sustainable assets and companies and the great outcomes. And I think what's pleasing is that this whole industry is starting to shift from a discussion around purely process, how we do responsible investment, what it looks like internally, how it affects valuations, to one around outcomes. And when we start talking about outcomes, then we've got a conversation that's much more appropriate for our underlying beneficiaries, for the consumers, for retail side. In Australia, it's a little bit unique because our institutional market is all driven by superannuation, which effectively is a retail conduit. We have a compulsory superannuation scheme, so every Australian is in fact an investor, and it's through those superannuation funds that they are the conduit to the retail market. And so I guess there's something of an arbitrary distinction between institutional and retail, because what we've really seen in the last couple of years is this uprising at the margins, and it's still small, so it's easy to overstate this, but of engagement from Australians with how their superannuation is being invested. And super funds here, many of them who are here, will tell you that, you know, they're getting a lot of inquiries from their members around issues such as tobacco or climate change or human rights, or, you know, where their money's being invested. And that's really taken off in the last couple of years. And those questions then quickly translate to questions that go through to the managers that are managing the funds. And so I think it's really fed right up through the value chain there, and it's started to shift things in Australia. What we found, though, a couple of years ago, if we're to unlock that demand, and we see that there's massive latent demand there still on the consumer side, there are a couple of blockages. We did some polling on this. The key things were, you know, there's a lack of information to really help consumers navigate towards investment products. There's a lack of third-party verification, independent verification of products that they're true to label, they're doing what they say and they're doing. And it's still just very complex to navigate. So our response to that was a fund certification program that we've actually had in place for over 10 years now at RIAA. We gave it an overhaul about 3 years ago and have really pushed this as an external verification that a fund is truly delivering what it says on the tin it's delivering. So it's a quality symbol. And we've really pushed that over the last couple of years. That's gone from having about 45 investment products certified to today we have about 150 products certified across all asset classes, all styles, from retail banking to equities funds to wholesale funds to private equity to fixed income, etc. So now we can go out to the major wealth management firms and the platforms and say, well, do you have the appropriate products there? Because your clients are demanding it. There's a risk that you're losing business here. And we are starting to hear that anecdotal evidence of mandates being lost or won off the basis of being able to provide the right advice for clients. And so we think that's a really key way of kind of unlocking that demand and channeling more money through to responsible products.
I think there's some interesting things happening there. So, Flavia, you've got to speak for a whole continent. Maybe I'll make it easier. The things I've heard from Lisa and Simon are the messaging, need for product, and certification. Does that help you summarise retail in Europe?
Actually, what I'd like to do is really shift the sentence that you quoted Lisa from, and actually coin a new one. So SRI can be big if the retail follows.
If the retail follows.
Yeah, absolutely. And what we have seen over the past years, indeed, with our study, is that there is an increase in demand from the retail, and a very significant one at that we've observed typically last year. We've seen an increase in retail demand from 3.40 to 22%. so you can understand what that means. And of course, we're really pleased about it. And I'm mostly pleased about the fact that I'm representing all the different SIFs, because at national level, I think that they're doing an excellent job in terms of raising awareness on SRI, bringing it close to the people, to citizens, and making them aware. So raising that awareness that Lisa was talking about, unfortunately, it's a problem that affects all other countries as well. It's not just a US confined problem. And indeed, it's a main one. And to go back to your initial question, indeed, it's made of lack of education, lack of information. At the high-level group, we're really trying to see how can we can engage citizens and the retail market at the same time. How can we push forward, and have more social engagement in this sense? And indeed, we must go back to the original question, which is financial education. At the end of the financial crisis, of course, there was much discussion with regards to promoting financial education for people. And of course, there have been different initiatives which have taken place at different member state level. The European Commission cannot legislate on anything that refers to education, can only make recommendation when it comes to different member states. So that's an important point to note. And member states have done their bit, some countries more, some countries less, in terms of pushing forward this on their educational agenda. What we're trying to do now is really speed things up even a little bit more and make sure that sustainable finance is embedded within financial education at European level. The shape that will take in terms of possibly labels, we've talked about the RIAA label. Of course, EuroSIF has developed the transparency code, which was mainly focused on the retail clients over 10 years ago. And now we're having discussions with regards to what does that mean and at European level, to have a standard at European level, which could also help the retail clients.
A very big development.
Yeah, indeed.
Okay. I think Lisa wants to make, is it a quick remark? Have to be a quick remark, then we've got to open to the floor.
I just wanted to say that I think following on Flavia's remarks, two of the challenges we face are sort of continued discussion over whether it's sustainable investing, responsible investing, impact investing, the words, the labels. There's a lot of conversation about how that hurts us. I actually think what hurts us is not having a messaging point that works for everybody, because it doesn't really matter what we're calling it. It matters what the intent and the mission is. And the intent and the mission for sustainable, responsible, impact investing is the same: how to use capital constructively, both for profit and to advance environmental and social issues. That's what we need to be talking about. And then secondly, at least in the US, there's been a lot of conversation about what is impact investing. And it means both across all asset classes, that's how we talk about it, and sometimes it only means private equity. And then we have a whole conversation about which is more impactful. Well, 1 out of 20 in the US, right? 22% in the US that are invested sustainably. We have a long way to go to get to 100%. So my view, and I think the view of EuroSIF, is that we should not be having these conversations about if you don't do this, you're having less impact. If you don't do this, you're going to have the least impact. Instead, we should be saying, how do you invest to have impact, period? Because what we're doing is saying one piece is more impactful, therefore your approach is a lesser approach. And then what we're not doing is inviting people to join us and take a first step. And I think that's incredibly important as this field moves on.
We've got to be inclusive. Okay, we're going to open it to the floor now. We've got 25 minutes left. Who would like to ask the first question, please? We've got roving mics at the back there. There's a lady down here in the middle, please. Who would like to follow, just so we can get the mic positioned? Okay.
Thank you. Thank you. My name is Mariska Douwens. I'm a credit fund manager. I was also wondering if you could elaborate a bit on the trends that you see between equities and between bonds. I mean, it seems that this is very much that equities are more in the lead in this whole process in social responsible investing. And do you see bond investors catching up?
Okay. So, split between various asset classes. Answer from each of you swiftly, if we can.
Very briefly, I think we've seen a real surge in the last 2 years from bond issuers to really tap what they're seeing as a major new source of capital for their issuances. And so we've seen a lot of thematic bonds being issued in Australia from the big banks, from corporates, from universities, others, sustainability bonds, social bonds, green bonds, climate bonds. It's been a real flood over the last couple of years, actually. But I think more broadly, what I'm pleased to see is the concepts of ESG integration are really moving beyond just a listed equity space into fixed income, and we're seeing some really good approaches to engagements with issuers from investors in the fixed income space to employing all responsible investment strategies and tools to a fixed income portfolio as well. So there's some really good examples coming out of QRC, for example, in Australia, and others who are really embracing this. Yeah.
Okay, and just eye contact with Lisa from Flavia suggests they're seeing the same thing in their regions. Okay, next question, please. Who wants to follow? I want to keep the mics moving. Okay, so questions everywhere. The gentleman at the front here at some point. Yes, the lady there, please.
Okay, my name is Regina Schwegler from INRATE in Switzerland. I would like to raise two issues, starting with the credibility or quality issue. I think we have a credibility and quality issue in sustainable investments. You already mentioned that. And I think that is a big barrier to growth for sustainable investments. I was part of an expert group in Switzerland, and we published a report this year about barriers. And first of all, I think we need to discuss about how effective are our sustainable investment approaches in really ameliorating the sustainable impact of investment. We call those investments sustainable, and we don't really know how much do they really improve impact on climate, on water, on societies. That's one thing. So I would like to have that discussion. EuroSIF and other organizations I would like to encourage to come up with a discussion, how effective are our approaches. And I think it all starts with measuring the right thing, measuring sustainability impact. And that's also what we had this morning. We need sustainability metrics for doing that. And there are some solutions already in the market. INRATE has been measuring sustainability impact from the first year that we are operating. And I think that needs to come much more. Do you have that in mind, and what do you think about that?
So I think the two questions linked questions is, do our sustainability investment approaches work in practical terms, and how do we evidence that? What metrics do we use? So that kind of takes us into what I would term the sector theology, whereas I think in some way the SIFs are rather more about delivery on the ground, so maybe we're not the right people to ask that question. Do people want to comment on it? Yeah. Maybe I'm wrong.
I could
Speak
answer just a little
briefly
bit.
and to the point if we can.
It's obviously, I think it's a big conversation piece in all our markets. There are multiple indices of sort of measuring impact that have been created in the U.S. I want to take us back a little bit because if you remember on my slide, I talked about ESG integration. And I want to talk about that because I think it gets a bigger piece of this, which is how do investors know what they're investing in to start with? So when we're looking at sort of $6 trillion out of our $8.72 trillion that is unidentified ESG integration, we have a report that we did after the 2014 Trends Report on our website that's called Unlocking ESG Integration, because we saw this massive number of undefined ESG integration. So we looked at the 16 biggest money managers that reported to us and also did a PRI transparency report, and we found only half of them actually fully informed in a public manner a potential investor on what ESG criteria they were using, what portion of the portfolio they were using it with, and what process it went through. And so to my mind and to our thinking, part of our strategic plan going forward is to increase the rigor in the field, because our concern is that if the field continues to grow using mostly unidentified ESG criteria, that there will be some loss of trust of those products, because the average investor, a professional investor, won't know what's in those products. And so I'm far more concerned about that piece than I am any other piece of the kind of transparency effectiveness puzzle.
Okay, Simon?
And I'll just add briefly, I think the approach we've taken through our certification and labelling is, I think you need to be cautious about prescribing what the outcome should be from a consumer, as opposed to offering different products that deliver different outcomes. But I think we've taken an approach that a product needs to be true to label, transparent, and make it very easy for a consumer to compare one product compared to another. Because I think there will be a diversity of products out there. I think that's really healthy in the marketplace, but I don't think we need to prescribe what should be in or out of a portfolio of any product. We need to make sure consumers have very clear see-through as to how a product differs. And so, through our certification, we're pushing portfolio holdings transparency, for example, which Australia is very poor on. But I think that's sort of the consumer-centric view that we take on that question.
Flavia, EuroSIF was mentioned. So.
Yeah, indeed. So I like to echo what my colleagues have said, indeed. This has been, well, what the points that you mentioned, the lack of credibility and the quality issue, indeed, are very big barriers that we've continuously identified in our studies, as barriers to SRI investing, to more SRI investing, indeed. And indeed, I think that something needs to be done before we continue. Well, of course, there has been, the industry has grown very rapidly. And at the beginning, it was interesting maybe to let it grow without putting boundaries. The boundaries can be very dangerous to a certain extent, and definitions as well. But now I think that the industry has come to a maturity level that really requires sitting down and having agreed principles. And this is another thing that we are looking into it as part of the high-level group, indeed, being able to come up with taxonomies which make sense for the industry, but which at the same time leave ample room for maneuvering and for the industry to continue thriving.
I think there's an interesting piece to be done on the extent to which labels and definitions boost a market. I suspect there are times in a market's development when they do, and then there are times when they would constrain it. And we as a financial services sector have got to get on top of this issue. That's just for fund management, same for banking as well. Raj, so your question there, and then this gentleman at the front, and there was a lady over here, I think. Was there one with you at the back, I thought, Raj? No. Okay, that gentleman there then, please.
Good morning, Piotr Biernacki, Foundation for Reporting Standards in Poland and Polish Association of Listed Companies. First of all, congratulations, especially to New Zealand, for such a huge rise in responsible investments in a very short time. And I would like to ask all of you for advice about how could fund managers persuade the companies, the CEOs, the CFOs, to turn more attention to good reporting of ESG issues, especially in such cases as in Poland, where we have less than 5% of assets invested using any sustainable criteria. And where the regulation enforcing non-financial reporting only comes into force next year. So we are before this huge turn, and still, if it is only a turn forced by the regulation, then it will, in my opinion, it will not turn good to most of the companies and most of the funds. So what are your ideas how to persuade the companies to report?
How to pressure the investee companies? I suspect there's probably different ways in the market. So briefly on that, all three of you, I think.
Yeah, I would just say really quickly, you have to change your boards. The boards employ the CEO, and when you hear consistently about Paul Pullman at Unilever, sort of the example globally of a good CEO, that is just sad. That we have so few that we want to point to at a global level. And boards have to see this as part of their mission because they employ the CEO. If you have a board that is focused on that, they hire the people who are going to implement. And so if I was to come up with a one-size-fits-all answer, and by no means is there one, that's the place I would start, because without a board that's focused on this, the senior leadership positions, they don't change in terms of the kind of person and their priorities.
Okay.
And I would just say it really goes to the point of investors, all of us in this room, using the full suite of tools we have available to us in responsible investment. And that goes to active ownership, it goes to voting, it goes to engagement, it goes to advocacy at a policy level, are really important elements. And so from our market, I think we're seeing a much greater willingness to use the full suite of tools available to investors. We're seeing much greater and deeper engagement between investors with issuing companies. And I think what's been really effective is actually collaborative engagements between industry bodies, between groups of our members, going to companies with very clear sets of expectations being articulated. And so there's been a lot of that activity in Australia at the moment in particular. And that's translated into a lot of resolutions being put up when those engagements are not perhaps progressing as they should be. But I would really say that the advocacy, active ownership, engagement are all critical elements.
Flavia?
Yes, indeed, these are very important conversations that need to take place. And indeed, as Lisa mentioned, today we are maybe luckier because we have some very good corporate leads. that can do a lot in terms of raising awareness continuously. We also try to work with, people that work in companies and that have to do with, relations with the different investors. And indeed, we try to raise the interest and try to make them understand how important SRI is to their investments. And I think that, on the policy side, things are changing. I referred earlier to the non-financial reporting directive, indeed, which I think you were also referring to, which is not a game changer, of course, but which will inevitably one of the very important pieces that will continue to, work towards more transparency. Disclosure is key, and we're pushing the Commission to go on and be more ambitious. We are also taking into account the excellent work carried out by the TCFD. And indeed, we will continue to push forward in terms of, making sure to have a sustainability reporting which is more integrated with, the rest of the financial reporting, as it's advocated, for instance, by the IRC.
Okay, so I think the message there is use all the tools available to you, which is regulation, leverage the regulation, and collective engagement, and change the boards. Yeah, thank you. So we've got a lady there, then the lady there. That lady, please, I think.
Hi, Fong Yi Chan from FTSE Russell. Was wondering if the panel can comment on developments you've seen in your respective areas around integrating ESG into benchmarks and or passive investment.
So Simon, I wonder if we could just give one person.
Yeah, who wants to answer that one? Into progress on integrating ESG into benchmarks. Any volunteer to answer that one?
No, none of us. Oh, there you go. So not a lot of progress, I think that indicates. I think in passive, though, I think we are actually, I think passive managers are being called to account a lot more to demonstrate and report on the outcomes of engagement, as engagement is the major tool there from passive managers. And I think, pleasingly, we're seeing some really good, solid reporting on engagement outcomes and processes, which I'm really pleased to see. Okay, we're going to have to pick up the pace. We've got 8 minutes left and at least 4 questions. The lady there then, Raj, please.
Thank you. Mine is not a question. I just wanted to share with you my own experience related to the topic that Sir issued on corporate involvement. I work for the London Stock Exchange and the Italian Stock Exchange. I cover asset owners, so what I do in my daily life is just to bring the voice of investors to the exchange to try as much as possible to reduce the distance between issuers and investors. What issuer says could be divided into 2 main answers. Very big issuers, so blue chips, says more that they provide to the market a lot of data, they publish wonderful CSR reports, they spend a lot of human capital and energies to answer to index providers and so on and so forth, but it's very rare that they receive structured feedbacks from investors. They would like have more and more opportunities for a direct dialogue with investors on sustainability topics.
Okay.
The second, I'm very brief.
It has to be quick.
Yes, absolutely. But I think it's important,
I'm sure it is, but it has to be quick.
SMEs, you are right. For them, there is lack of information and lack of education. We publish our own ESG guidance for our issuers in this respect as a stock exchange, and in Italy in July we organized the first Italian Sustainability Day, a roadshow fully dedicated to ESG dialogue, direct dialogue. This is kind of, expertise that I really would like to share with you, and maybe just work again on that.
So the stock exchanges are keen to support the work, but you probably quite rightly point the finger that the investors don't always respond in the way you'd hope. Okay, who was next? There's one at the back, there was one over that side.
There's a gentleman in the front row.
And this gentleman at the front, okay. We've got 6 minutes. Let's try and do 6 questions.
Mine's not a question either, it's a statement. And it comes back to just answering the question from the gentleman in Poland. Hermes provided a presentation this morning which was about research, which is about how do you engage. The only thing I'd say is before you go and sack the board, they're the ones you should be engaging with rather than the CEOs and the CFOs. That's what the research shows, because they're short-term and the board should be long-term. If they don't make changes, then change them.
Raj, yours?
Hi, I'm Nicola Redmer from the CEO firm. I have a question for the European context. There's a lot of regulation and discussions going on at this point in time, and I wonder whether there's still a significant role for the nation state and which it should be.
I think that's for you. Nation state versus EU.
Yes, of course. Well, I don't really understand the question in the sense that, of course, there is always going to be the legislative process that the European Commission enacts, which has to do with, EU legislation, of course, which then have to be embedded at national level, and that happens, generally speaking, according to how, they have to be received. Of course, taking into account what the national context is. Now, I suppose that you're referring to specific changes that might come as, okay, right. So, well, of course, as our chairman of the A-level group yesterday mentioned, we are looking at a number of issues which need to be tackled from the legislative point of view. We are not looking necessarily to revising omnibus legislations, of course, for each single piece of item that we're tackling. But we're looking, and what's going to help us work in this respect, I believe, is really how to make sure that we make correct adjustments to existing legislations, which will be able to allow us to make those significant changes that will help in, embedding sustainability into the financial system.
I think the skill for any SIF is to work with the people who can effect the change, sometimes government, and I imagine in Lisa's case now states and cities. Okay, the gentleman over there, please.
Okay, thank you. Hendrik Schmidt from Deutsche Asset Management. Just a quick one on the EuroSIF discussion. Shareholder Rights Directive urges for increased shareholder engagement, also with regard to collective engagement. What is your stance on the problem between collective engagement and acting in concert?
Sorry, collective engagement?
Collective engagement and acting in concert problem that we, especially here in Germany, face currently. And when we talk about European legislation, regulation, and national implementation, we definitely need to find a way forward first before national regulation can step in here.
Yes, indeed, and that's very connected to the question that was previously asked. Well, I think that, as I said before, Shareholder Rights Directive is a very important piece of legislation, and it will have to be implemented at different member state level. I'm confident that the discussions that will be taking place at a national level in Germany will ensure that the legislation will be passed in a way that it will help the system be more transparent, because this is the final goal of the directive, and will, and will make sure, and I think that all the policy people involved will make sure that it will tackle the right points, and it will make it enactable in your country as well.
Okay, we've got one there which hopefully Lisa will be able to answer. We're not handing on America recently.
Okay, well, actually, this is a question for Simon and Lisa, because we've already...
Good. Ask it.
I'm Nicola Marshall from Spar Invest, and we're members of EuroSIF, so we've already fed this request into EuroSIF. It's basically relating to passives and how you are actually going to make some progress on that front. And one of the things that we requested in your surveys, actually, could we know what money is being invested sustainably through passives and what through actively managed funds, because I think that would really help to focus and make it more transparent.
So what is the question? Is it the sort of split between passive and active?
Would you please consider doing that in your surveys?
So in our trend surveys?
Yeah.
Interesting. Okay, that's interesting feedback. Thanks.
Yeah, we'd consider it. Yep, great.
That's the speed of question I like. We've got time for one more question. First hand up gets it. No, okay, I'll ask it. 30 seconds each. Biggest challenge in your market and how you're going to overcome it. Lisa, go.
The biggest challenge is working in an administration where we cannot control the agenda in any way, shape, or form.
And how do you get around that?
Being on a response mode all the time.
Okay.
And I don't have an effective response in the near future.
Simon?
Yeah, I think one of our greatest challenges is that we don't have a legislative environment nor a political environment that's currently supportive. And we've been in gridlock around climate and energy policy, for example, for a decade and a half, and it's not looking like we're going to resolve that. And so we have an investment community that is ready to allocate capital to support a transition to a lower carbon economy, and a political environment that's not there to support it in any way. So we're having to find ways around that, and pleasingly we are in some extent, but we're not quite there in terms of the support.
Tactical, niggle away, get a bit of ground here, there. Yeah, okay. Flavia, biggest challenge, how are you going to overcome it?
The biggest challenge is having the opportunity to be working with this high-level group and to be given the chance by Europe to actually work on devising a more sustainable financial system, which is a reality. And I hope that we'll be able to do interesting work, which will be able to spur change, and therefore capitalizing on this opportunity in the best way possible for the industry and for everyone.
It's a great opportunity.
Indeed,
we
it
should
is.
with it. Okay, well, we've got 23 seconds left, which is just long enough for me to thank our three panelists here, Lisa Woll, Simon O'Connor, Flavia Micilotta, but also I'd like to thank you for your questions and your interest. Thanks very much indeed. Goodbye, everybody.